Right, well, the fundamental accounting equation, we showed you the structure of how those entries were recorded to understand the balance between the assets, the liabilities, and the owner's equity. And now we should refer to the accounting department's version of the opening day balance sheet. So the opening day balance sheet now is presented in an account form rather than transaction level detail that we just constructed through our opening day chronology. And here we see that the assets have been organized into a certain structure. The upper left-hand corner, we find the $6,500 cash on hand that we created an expectation for on our opening day cash balance. So we see that the cash on hand audits with the available cash balance in our cash account. The next account is the time deposit that we made for $12,500. Other current asset accounts in which we have no balance as a certificate of deposit. Other current assets, which may be things like prepaid expenses. Accounts receivable, well, on opening day we haven't transacted any sales, so we wouldn't be likely to have an accounts receivable. And there we find the $24,800 in inventory that was provided from the vendors. So the current assets total $43,800. Below that we find what's called the fixed assets or the long-term assets. The building and equipment that was recorded at book value. We see the furniture and fixtures in the amount of $98,400. The smallware equipment, $9,200. The building, $217,600. The value of the land recorded at book value, $150,000. And the leased property of $80,000. So the total property adds to $555,200 with the total assets equaling $599,000 that we indicated earlier on the fundamental accounting equation. Now note that the assets are divided into current and long-term things. This is an important accounting distinction that is also held on the opposite side of the balance sheet with the liabilities. Note that we have current liabilities and long-term debt or long-term liabilities. The accounting distinction here has to do with time. The current assets are things that we expect to consume in the near term, certainly within 12 months. Inventory would be a good example, food specifically. While some of our beverage category, particularly in the fine wine area, we may carry an inventory for longer than a year's period of time, particularly if we're trying to develop an extensive cellar. But the theory is that inventory is in fact perishable and over time is constantly replaced. So that inventory is constantly turning over and is recorded as a current asset. Things that are recorded as current are expected to be consumed on the asset side or required to be paid on the liability side within the upcoming 12 months. That 12 months is not a calendar period of time, but represents a rolling 12-month window. So if you will, at the end of the first month of business, a 13th month is added to the end of the current liabilities window and represents months 2 through 13. We still have 12 months or a rolling year. At the end of the second month, if we're using monthly financial statements, a 14-month is going to be added. The first and second months are gone, and 3 through 14 represent that rolling 12-month horizon. And that is the accounting definition of current as it recognizes liabilities. That which is due and payable in the upcoming 12 months. The long-term debt is what's due and payable beyond that rolling 12-month window. And the sum of the two, current mortgage, for example, the current portion of the mortgage, plus the long-term portion of the mortgage on opening day, you might note, if you were to sum that with your calculator, equals the $305,000 total mortgage that our private investor provided to us that enabled this project to become a reality. The same is true with the capitalized lease. Notice that the current portion of the capitalized lease is $6,799. The long-term portion, $73,201, and on opening day, it too sums to the $80,000, which was the total contribution or value of that capitalized lease from the kitchen leasing company. The stockholders' equity we see has actually been recorded in two separate accounts. The $100,000 contribution was actually the common stock contribution, and the $50,000 was recorded in an account called additional paid-in capital, also known as contributed capital in excess of par. That account can be viewed as a loan from the shareholders that can be returned to them over time. The permanent equity contribution, however, will remain on the books at $100,000, which is the common stock entry. Up to this point in time, we have focused our discussion solely on the balance sheet, the opening day balance sheet. It's time to turn our attention to the winter quarter marketing plan, which will be the opening quarter for our enterprise. And here we find that the financial statements are going to represent a quarter or 3 months worth of business. And now we want to refer to the winter quarter marketing plan document for our place. All right, the marketing plan for the opening quarter reads as follows. During our opening quarter, we will feature numerous promotions on selected menu items that will likely result in food costs approaching 40%. The marketing campaign will be extensive. Local media, publication, and in-store advertising promotions have been budgeted at $9,000 for the quarter. Staffing levels will average 12 FTEs, full-time equivalents, per day, and the definition of an FTE is 8 labor hours per full-time equivalent, at an average wage rate of $10.75 per hour. Dining room table and service amenities, which would include things like flowers, napery, packaging, etc., are budgeted at 85 cents per food order served. ASCAP and BMI royalties, in addition to live entertainment on weekends, is budgeted at $5,000 for the quarter. A 12-month repairs and maintenance service agreement has been entered into in the amount of $14,000, and it is to be paid in quarterly installments of $3,500. Management is responsible for putting together the marketing plan, and the marketing plan, as you see, largely consists of expenses. So what we want to do now is look at the forecasted statement of income, a pro forma, or a budget, if you will, that the owner has prepared for the management team's use in making decisions on the opening quarter. The statement of income, in this case, is a budget or a pro forma. It's a guess, it's a forecast of what we think is likely to occur. And in new business enterprises or business plans, it's not uncommon that forecasts are presented in a multiple column format, because after all, it's a forecast. Nobody knows exactly what's going to happen. And in our place, we see that 5 columns of varying degrees of revenues and expenses has been prepared. 3 is probably the minimum. 5 may be towards the excessive, but 5 has been constructed. You notice that as we move from left to right, or from worst case to best case, the revenues are increasing. And to support those higher revenues, which are likely the result of higher levels of customer traffic, some of the expenses are rising as well. The middle column, which is labeled as the best guess, is generally viewed as that volume of business, the revenues and expenses associated with it that management thinks is most likely to occur. And as we move to the right, volume goes up approximately 5% as we move from the middle to the next column. And conversely, as we move to the left one column, you'll notice that the revenue is decreasing by 5%. If you notice, we drop down below the sales and cost of sales through the controllable expenses into the occupation cost category. You notice a distinction in these expenses versus the controllable expenses. As the sales volume is changing on our projected statement of income, an observation you make here is that the occupation costs are not changing. So these expenses will need to be met on a quarterly basis regardless of the sales volume that the restaurant happens to enjoy. Therefore, it's incumbent upon management to ensure that the operating profits that are generated are adequate to cover the occupation cost in order to produce a profit. Now, what I'd like to do here is to spend a little time in the middle column matching the marketing plan overview with the numerics for some of the line accounts that we actually see. For example, the payroll. The marketing plan suggests that staffing will be 12 full-time equivalents per day at $10.75 per hour. So let's audit the payroll expense forecast for the middle column value on our pro forma. Payroll. $12 full-time equivalents times 8 hours per full-time equivalent per day times $10.75 per hour times the number of days in the quarter. And at our place, we are operating 91 days a quarter. If you take the time to run that calculation, you'll find that the payroll is $93,912, which is the amount that's been recorded in the middle column for payroll on our projected statement of income. What I'm attempting to do here is to demonstrate the link between management's actions in creating the marketing plan. Recall one of our opening slides dealt with the interplay between marketing, operations, and finance. Most of what management gets involved in is expense creation. Think about it. Do you staff the restaurant before or after the guest arrives? Is the music on or after the guest arrives? So largely, management is responsible for creating the expense package that encourages the guest participation in this venture. And if done so to an appropriate degree, we generate revenues that hopefully are greater than the expenses in order to generate a profit for this business enterprise. Other expenses in the middle column that we might want to take a moment to audit, if you will. We can look at the music and entertainment budget of $5,000 that we committed to pay, and we note that we see the $5,000 in the middle column in music and entertainment. The $3,500 quarterly payment for the repairs and maintenance contract is recorded in the middle column as well, and we note the $9,000 in the advertising and the promotion. Other aspects of the controllable expenses did not appear on the marketing plan because they are largely beyond management's control. For example, employee benefits. Well, employee benefits, according to the Uniform System of Accounts, are largely expenses that are legislated. Payroll taxes that the business is obligated to pay. Federal unemployment taxes, as an example. State unemployment tax, workman's compensation, insurances, etc. Some expenses and employee benefits may, however, be discretionary on the part of management, such as attending an executive education program as a continuing education benefit from the organization, and that would be the appropriate account for that to be expensed in. But for now, we're going to move forward. That's the forecast. We expect $316,301 or thereabouts to be generated in the first quarter. And if the expenses are able to be controlled at the levels that management has planned for them to be, we should produce an operating profit close to $26,235, which, if you notice, is inadequate to cover the occupation cost. It is not uncommon in a new business enterprise that we are not operating at a profitable level in the early stages of that business's life cycle. The implication there is that there needs to be adequate resources and cash available to us either on the balance sheet or through some other provision. And you might recall that part of the agreement on the $30,000 note payable was access to a revolving line of credit should we need access to that cash. Access to cash when you need it is more important than having the cash on hand.